Hey guys, John Michael here with Peridot. Hope you're doing well. I'm going to talk to you about this new tax law that just got signed in on July 4th, 2025, referred to as the One Big Beautiful Bill, the Tax Provisions Summary. You're going to see me looking over here a lot just to disclose because there's a lot to it and there's a lot of notes, so I'm going to have to be checking my notes over here. So bear with me on that. But I just want to talk to you about some key tax provisions that was in that bill that you may be interested in. First one we're talking about is the standard deduction was increased. So everybody gets a standard deduction, or you itemize, you take the bigger of the two. For single, it was increased to $15,750. So keep in mind it was already high. So they've increased it a little bit, about $700 to $1,000 per one. $15,750 single, $23,625 head of household, and $31,500 for married filing joint. What does that mean? That means automatically up to $31,500 if you're married filing a joint return. Automatically that much of your income is not going to be subject to federal income tax. So that's sort of zero income tax threshold there. Only amounts over that would be subject to tax. So those standard deductions are free give-me deductions that everybody gets. A lot of people talk about taxes and tax planning. Just note that the original Trump tax bill signed back in 2017 lowered a lot of taxes. What this bill did is it those tax rates, if you look up your tax rates and they're graduated, meaning at certain income levels they're taxed at different rates. Those were made permanent. So permanent means until Congress changes the law in the future. So those are not expiring. Previously, they were set to expire to 2025. So this bill made that permanent moving forward until changed again. But if it never gets changed again, it's the tax rate in the land. So kept the tax rates the same. It increased that standard deduction a little bit, so the bottom income is going to be taxed higher. That's not going to be taxed. That's good. If you're a senior, you're getting a 65 and older. That's a senior. You're going to get an extra $6,000 standard deduction, or an extra $6,000 on top of your standard deduction. So that's nice. The one thing that was going back and forth, and it's now law, is they increased the SALT cap. That's that stands for state and local income tax. So when we get over to the itemized deduction side, remember you either take the standard, which is those high numbers I just shared, or you itemize. If we get over there, there was a cap on how much you can put into your itemized bucket for local state and local income taxes. That cap was $10,000. They increased that cap to $40,000. So if you have a lot of property tax, a lot of state income taxes, you now have more of those state taxes that can add to your itemized pot than was previous. So that was one thing that increased. This is a new thing. They call them Trump accounts. So what this is if you have a new child at birth, the government funds $1,000 into this account. You're allowed to put up to $5,000 a year into this account. If you're an employer, you can put you can contribute up to $2,500 a year for your employee. It's not income to the employee into this account and get it as a deduction. So that's a benefit. It can grow into this account. Let me qualify here. When you put the up to $5,000 in, that is not a deduction. It's not like an IRA. You cannot deduct that on your taxes. But you're putting this money in. It will grow tax-free, the growth on that. When the child turns 18, they can convert that into a traditional IRA. So they're going to get that you're going to put that money in, that it grow, and then you can convert it to a traditional IRA. So that's a benefit, because if you want to have your kid, give them a head start on a retirement account, you can't really give them an IRA or Roth unless they have some earned income. So this is a way to do that without having to, them having a job, basically. Moving on, child tax credit. This is a credit if you have children. You get a credit, so there's deductions that reduce the amount taxed. credit is a direct return of taxes paid. So you get an increased credit for a child of $2,200 per child that's under 17. Starts phasing out over 17. And that will go up every year. So right now, $2,200 is for 2025 tax year. Here's one we've been hearing a lot about: no tax on tips or overtime pay. So this is true, not true. And what I mean by that is obviously it's true. Up to $25,000 a year in tips, you don't have to pay taxes on. And what I mean by true, not true is they're going to get that. They're going to it's going to have to be reported on their W-2. They're going to pay taxes on these tips. But when they get to their personal tax return, they're going to get if they have tips, up to $25,000 deduction on their tax return to offset that tip income. So it's not that the tips aren't taxed, but they're getting a $25,000 up to $25,000 offset to bring down what was taxed. So it's a indirect way of not being taxed on tips. That's similar with the tips and the overtime pay. Same thing. Overtime pay can be confusing because if somebody's getting paid $10 an hour and they're working overtime, they may get time and a half. They may get paid $15 an hour. The amount that's non-taxable is that $5 difference per hour. This has to be maintained. It's highly regulated. And it meticulously, you have to create the paper trail meticulously on these were the overtime hours worked, this was the pay, and everything to get that. But that is that. So Social Security income deduction. The Social Security benefits that seniors get or retired people get can be deducted above the line up to $6,000 per person, or $12,000 per couple. So you're getting an extra Social Security deduction for those out there that receive Social Security. It does, like most things, have phase outs. If you make too much money, then you're not going to be able to get that. Keep an eye on that. Charitable contributions. So this is starting in 2026. One downside of high standard deductions was that the itemized deductions sort of become less relevant. So you have a really high standard, and if that's higher, you're going to take that. Sometimes itemized deductions are less relevant because they're not going to get to that standard. One of the key itemized deductions was charitable contributions. So there was a while there where the impact of the charitable donation went away because standard deductions were so high and you weren't getting a tax benefit if you gave to charity because you just weren't getting to that standard rate. Well, they're allowing in 2026 you to do what they call an above the line. So it's not an itemized deduction anymore. It's now just nothing to do with standard or itemized. Up to $1,000 if you're single or $2,000 if you're married, like that above the line deduction. So if you give $5,000 to charity and you're married, $2,000 of it will go above the line on the front page of your tax return. You'll get the $2,000. The other $3,000 will go into the itemized deductions and add up over there, and if it's relevant or not. So it's a good thing. They introduced something like that back during COVID times, but it wasn't this much. It was like $200 or $300. Now it's 1,000 single, 2,000 married, so that's a good thing. Obviously to qualify charitable donations. This one's it's a new thing. So if you have a U.S. assembled vehicle, you can deduct the interest paid on this U.S. assembled vehicle. I guess you're going to have to look up the car and see if it was assembled in the U.S. But this U.S. assembled vehicle, you get a interest deduction on the financing of that up to $10,000 a year as a itemized deduction. And it obviously has a phase out, certain phase out income limitations to that as well. Green energy credits. So the infrastructure bill a couple years ago, they gave a lot of incentives for EVs. There's been ongoing incentives for electric vehicles for a while now, ongoing incentives for solar and solar batteries and items like that for a while now. This bill is eliminating those, so we have, depending on when you're watching this, until September 2025 to take advantage of any electric vehicle credits. So if you bought a vehicle previously in 2025, or you're going to be buying one, and you want that up to $7,500 credit, and you qualify for it, you got to do that before September 30th. Anything after that, you're not credit. So I assume the electric vehicle car lots are going to be empty that first week of October. So you want to take advantage of that. Solar, residential solar credits go away December 31st. It's a common question. Hey, I paid the solar guy, but he's installing it. He's not going to be able to install it until 2026. It's the cost installed. It's the cost in service. And service means installed. So if you want that, you better get on it. It's going to be December 31st. Still get solar if you want to get it. You're just not going to get that up to 30% deduction, which is a pretty good deduction for it. If it's business solar, you have an extra 6 months to do that. But yeah, just be aware of that. Be aware that those things are going away. Yeah, so this doesn't apply to most people, but there is what they call an estate tax. So an estate tax is if somebody passes, they have a lot of assets. Those assets may be taxable, but they have a really high exclusion on if anything's taxable. If you're single, that's $15 million. If you're married, that's $30 million. So unless you have $30 million of assets, houses, cars, equipment, cash, investments, it's not going to really apply to you. But if you had 31 million and you passed away, 1 million may be taxed. It's called the estate tax. Obviously, states may vary, so you got to look into that. Some of those rates are starting 2026, but it's a high limit. And that's most of the relevant provisions. I'm just making sure, I'm checking my notes here to make sure we're not leaving anything out. It appears that's the main ones we wanted to discuss. So, pardon my in there, I just had a lot of notes here and I wanted to make sure I wasn't leaving anything out. Obviously, there's a lot of things I'm not mentioning in this, a lot of thresholds and details I might have left out. But those are the key provisions that maybe you might want to do. If you have any follow-up, just let us know. Thanks.